Have you ever had that moment where you open up your investment account and your stomach drops because the numbers, well, they're way lower than they were last week?
Or opposite, you check and you're up big. And suddenly you're wondering, should I sell now before it all disappears?
That emotional roller coaster is exactly why so many people struggle with investing. It's not just about what you buy. It's about how you think when the market is doing its thing.
And today, we're giving you our 5 rules for long-term investing. The ones we actually use ourselves. So you can stop second guessing every move.
We'll break down the 2 stages of investing, explain the differences between ETFs and mutual funds, and help you figure out if you really need a financial advisor or if you can do this yourself.
Plus, we're going to be sharing a simple strategy that helped us and a ton of our listeners stick to a plan and really grow their wealth without having to watch the market every day.
If you've ever wondered, am I doing this investing thing right? Stick around, because by the end of this episode, you'll have the confidence and clarity to invest for your future without losing any sleep. This is the FI Guys. Welcome to the FI Crash Course, episode 8. Dominic, welcome to doing this again. We're back to the FI Crash Course remastered. Before we get into the 5 stages or the 5 strategies that the FI Guys have created, what do you think?
I'm excited. I love the little remastered part on the intro. That's good because it kind of pays homage to the original FI Crash Course we did. I guess if you, the viewer, are kind of biting at the nails and chomping at the bit to, well, what's episode 9? What's episode 10? I guess in theory, you could go back and listen to the old OG FI Crash Course, preferably audio only. Don't look at the visuals. I don't even remember which studio we were in back then, but we've had many iterations in our time podcasting. So I'm excited. I think this is going to be a great one. This is one of my favorite ones, obviously. Investing is what we do here, so this is going to be an exciting one. So without more dilly-dally, let's hop in. Let's get into the meat and potatoes, and let's help some people today.
Let's do it. So I first want to start out with the FI Guys 5 rules for long-term investing. This is, if you just listen to these 5 rules, I can almost guarantee you're going to do pretty darn well. You'll probably even beat most institutional investors just by sticking to these. Number 1, the market tends to go upwards on the long term. Historically, the S&P 500 on average has returned about 10% annual before inflation since before 1928.
That's a long time ago. Hey, that's a really good stat, right, Chris? Because a lot of people have fear in the markets that, hey, I'm gonna lose all my money. What happened? But you're saying that traditionally it's always gone up. And there's been bumps and crashes and, war and COVID. But it seems to always rebound.
Yeah, and the thing I always tell my clients is the day that it doesn't rebound, we have bigger problems than your retirement. We have bigger problems than your money. So let's keep it going. Let's just stick in there, because so many people say, man, if I could just get a 10% return, I would be so happy with that. And they go around and they run everywhere trying to figure out, what do I need to do to get this 10% return? And all you need to do to get that 10% return is set it and forget it and literally sit on your hands.
Mm-hmm. And when you say, for those that might not have listened to the podcast before, they're kind of curious, what did he just say? If the market doesn't come back, we shouldn't be worrying about the money. What are you talking about there? Just so people know.
Oh yeah. So I'm saying that if the stock market doesn't return back to what it is, typically what ends up happening is you end up having a full-scale economic collapse. Again, so you have bigger problems than my retirement account, because even if you had that money, unless you wanted to get out of the country, we're going to have bigger issues. So when you say the stock market has returned every single time, because historically it has, and the day that it doesn't, we have bigger problems than anyone's individual 401k.
Okay, good to know. Just wanted to clear the air. Make sure, if an alien attack comes, don't really worry about the 401k. We got bigger problems, and might have to fight off some aliens. Let's get on to number 2. What do we got for that one, Chris?
Number 2, this is the one that we were just talking about. Corrections happen. On average, the stock market drops 10% or more every 1 to 2 years. But every time, just like we said in point 1, it has recovered. So I think it's important to say that, hey, it returns on average 10% per year, but that doesn't mean every single year that it returns 10%. There are going to be some years that it's up 20. The next year, down 0. On average, 10% per year. And that also means that every so often you can drop by 10% and still be okay. And then every so often we have major corrections every 7 to 10 years where it's 30% drops, maybe even 50% drops. And again, that's okay. Because to point number 3, you can't time the market consistently. Even the professional traders rarely get it right. So what makes you think that you have the ability to do it? That hubris, that thought that I am the unique person in the world to figure it out, has led so many investors astray. And that's the reason that the average investor cannot beat the market. That's the reason that the average investor has a return around 2 to 3%. We're literally setting it and forgetting it. Beats that by almost 4 to 5 times.
So in this case, it seems like the easier option is actually the better option, right? If I was looking at the market every day, trying to time it and pick the right stock, or maybe I just look at the market every day and I get stressed out. That's not really the best way to go. What you're saying is set it, forget it, and do your due diligence up front. That way you can go out and leave this financial world behind and really focus on what life is really about. Right, Chris?
No, you're exactly right. And that actually leads us to point number 4, which is set it up and step away. Once you have your plan, watching the daily ups and downs does nothing more than cause you to just stress out. And I know this is counterintuitive because every other point in our lives, the more work and effort we put into things in general, the better results we get out of it. But here in this investing game, it's actually the opposite. So people think, if I'm looking at things all day, if I'm getting stressed, if I'm watching CNBC, if I'm watching these news things, if I'm freaking out every single day and clicking my mouse and zooming in and out, then I'm doing something. I have to be getting better. But here, it doesn't work. But it's complete opposite the way the things work in real life. If you're a jiu-jitsu player like I am, and you like to go and work out and train and roll every day, well, saying the way I'm going to get better at jiu-jitsu is by not training. It's by sitting at home and watching TV. That doesn't work in real life. But in investing, for whatever reason, it does. And that is awesome for us because it allows us to get out of the day-to-day grind of looking at these charts and get into real life. Because life isn't lived in spreadsheets. It's lived right here, right now, outside of that.
I love that. I love that. You're spot on. Life isn't meant to be lived in the spreadsheets. They're meant to be lived outside of it. That's awesome. What do we got for number 5?
Number 5, our final one, is don't panic sell. The people that get the worst returns often come from bailing out during downturns. I know that it is hard. Emotionally, it is difficult to watch your life energy dissipate right in front of your eyes. But it only goes away for real when you sell. So to recap the 5 guys' rules to long-term investing, the market tends upwards in the long term. Corrections happen. You can't time the market consistently. Set it up and step away. And number 5, finally, don't panic sell.
That's good stuff. That's good stuff. If you can just implement that in your life, your finances would be a lot easier. But easier said than done, right, Chris?
Unfortunately, yeah, majority of finance comes down to your behaviors. That's the reason we call it personal finance. And majority of personal finance is far more personal than it is finance. It would be very easy to say, just set it and forget it and then walk away. It's so easy that people overlook it. They think, no, that can't be the real thing. Tell me the real secret, Chris. When in truth, that is the real secret. Just stop messing with it every single day. So I'd like to move on to segment 2, the 2 stages of investing. The stage that most people are in, the stage that most people who are listeners of the FI guys is in this stage number 1, the wealth building stage. It's usually early on and midway into our career. And in this stage, we're focused mostly on growing our investments. And by growing our investments, that means we're trying to get things like equities. So that means stocks or shares that represent ownership in a company. And I think that's a really important point that we should talk about. Because I think when most people say, I'm going to go buy this stock, they actually don't know what the hell they're doing. They're buying what they think are just numbers on a page. And those numbers on a page go up and down based off of the whims of the universe, of some butterfly, of Allah, of whoever the hell they think it is. But in truth, when you buy a stock, you are buying a ownership of that company. So I want you to think of a pie. And if we're to create the Fi Guys stock, and let's break it up between me and Dominic here. So Dominic, you own 33%, I own 33%, and our listener owns 33%. For you to own that stock, you now own 33% of the Fi Guys. So that is what is happening when you're buying a stock. When you're buying a stock from Apple, I don't know, Tesla, whatever company you want, you're not going to buy 33%. I mean, if you have a lot of money, then you can go for it, but there's no way in hell that you're doing that. What you're going to do is you're going to buy such a tiny, tiny little sliver of that pie. But that means that you have a tiny, tiny sliver of that company that you get to own. And that's pretty cool that our system allows you to do that. And allows you to do it so easily. When we're in this early stage, more aggressive allocations, historically 70 to 100% in equities for maximal growth potential has helped people in this stage. But you also need to temper that with your ability to withstand the ups and downs. Because everyone says, oh, I can deal with volatility until volatility comes, until those ups and downs comes. Not really so much the ups. Everyone likes the ups. When the downs come, that's when you see who's freaking out. There's an old quote from Warren Buffett, which is, only when the tide goes out do you see who's swimming naked. Only when things get bad do you see who's going to panic sell.
I'd hate to go swimming with Warren Buffett. Interesting. No, that's a solid quote. I think a lot of this is actionable. A lot of what we're talking about today is simple, but would you say it's easy? I always love that quote. Simple, but not easy.
Yeah, it is simple, but it is not easy. Because again, it has nothing to do with the math. It has to do with the mindset. And that's why here on the Fi Guys, we talk so much more about mindset than we do the math. Because there are hundreds of thousands of other podcasts that talk about the math. But I think something that we're uniquely qualified for is to talk about the mindset. And the best part about talking about the mindset is that's 80 to 90% of getting you where you need to go. And we can also talk about the math, because the math is actually pretty damn easy. It's just math.
And that's
Let's go ahead and
important
move on.
That's super important though. Like you said, I mean, I just want to chime in real quick before the next one. This math is easy, right? I know oftentimes, you might go into like Yahoo Finance and check out a stock and it's like, what is this beta and 52 week high and low and price per earning? And what is all of this? What is, it's like, it's not that deep, brother. It's not that deep. It's very simple. And you have something to add real quick?
No,
I saw you light up real quick. Yeah, go for it.
I was going to say the financial industry has really made a lot of money off of overcomplicating this to the nth degree. And the way they look at it, because I used to be in finance, shoot, I still kind of am, is that they make money off of our ignorance. And our ignorance was fabricated by them making things more complicated than it needs to be. Again, how lucky are we that we live in a system that we have the ability to buy ownerships in stock on our phone any day, any time of the day. And it's that simple. Now we have issues with us trying to not gamify it and not trying to make it into this thing where I think I can beat everybody else. Sometimes the easiest thing to do is just to spend less money and wait longer. And you can live a much better life than the constant ups and downs of, am I happy today or am I sad today? Based off of what something completely out of my control, the stock market decides to do. What do you think, Dom?
I think you're, it kind of cracks me up, the whole gamifying the stock market, since it's so easy. And with the introduction of like Robinhood, who makes it, the app looks almost like a game, right? It's not like Charles Schwab or TD Ameritrade or one of these brokers where it's like super official. And are you ready to purchase stocks in this company and become a shareholder? And it's like, no, Robinhood's like, hey, you got money, throw it in. Let's see if it goes up. Let's see if it goes down. And it's very dangerous. And I got sucked into that too. I definitely got sucked into the whole Robinhood hype back in the day when it just first came out. And I remember one time, this is before I was financially wiser, we'll say. And I wouldn't recommend this, but I was trading stocks on my phone like every day. The ego of man, I thought I could game the market a little bit, get a little bit out for myself. And yeah, I mean, exactly right. I remember a scene in my life, scene as if it's a movie. Sometimes it is. Where I have a bad habit of taking my phone in the shower, listen to music or like check stuff or whatever, right? And I was literally trading stocks in the shower, and I made like $500 in the shower. And I was like, oh wow, like I had to take my clothes off, but it wasn't for the reasons you think. But yeah, it just cracked me up, and would not recommend. Would not recommend. Right? Because
Why
nobody
wouldn't you
beats the
recommend it
market.
though, Dominic? You made $500 in the shower. You
I
won.
made $500 in the shower. Right? That's pretty solid. That's a good shower. That's a golden shower right there. Sooner or later, you'll get wiped out. Sooner or later, you won't have the proper risk management, and you will get wiped out. Because my dad always says this quote, and I love this. He said, "Bears make money, bulls make money, but pigs get slaughtered." And oftentimes, you get too greedy. You got too much in the market, you just end up wiping out, right? It's like going to the casino, right? And essentially it's the same thing. And you're playing blackjack. You're like, all right, for this weekend, I brought out $500 to gamble with this weekend with my friends, right? And you get to the table, 500 first hand. It's like, what, bro? Slow down, slow your roll. You don't want to blow it on your first spin. You're just like, yeah, but I could double it all. It's like, no, that's bad. And that's kind of what it turned into for me, right? So not that extreme. Yeah, I wasn't risking it all on options or something crazy like that. But it's better to have and build good financial habits and disciplines rather than your ego taking over and thinking that you can beat the market. You can beat the guys who went to Wharton and Harvard, who spend 12 hours a day looking at a screen doing the same thing. Like, you have more knowledge than them. You don't.
And not only that, now you're going against quantum investors who have fiber optic cables that are milliseconds faster to transact trades at millions of trillions of dollars faster than you, and you think you can beat them sitting at home
on an iPhone,
in your pajamas. It's going to be difficult. And I just want to talk about something there, is that It's okay if you have been that person that woke up every day and traded. Just like Dominic said, I did it too. For a long time, I was doing options trading. I was doing value investing. I've gone through all of the different, not all of them, I've gone through many different modalities in trying to figure out what is the right investing strategy. What is the one right investing strategy? And to be honest, the reason that I'm at this stage of my life that I am, where we get to do this podcast, where I get to own my company, where I get to chill every day and go surfing and hang out, do all this stuff, is because I was pretty good at all those things. And if you rewind the clock back and you looked at all the stress, all the time, all the effort I put into it, I could have gotten almost similar results by putting it into the market and stepping away and enjoying living my life. And that's the hardest part about life, is we don't get a control group. We only know the way things did happen, not the way it didn't. So if you have the humility to go back and look at all the struggles and look at even your successes and say, okay, that success was awesome. And I don't know what would have happened had I not gotten that success, had I literally done nothing, until you actually go back there and you do it, which I did. And you found out that for all the work and effort, I took out like 1% additional, 1 to 1.5% additional for years of work, effort, hours of waking up at 4 a.m. to get onto the stock market before things opened, since I was on the West Coast. All of that for 1% was not worth it.
It's better to just go out into real life, guys, and just go build skills, build relationships, go live life. And like Chris said at the beginning of the podcast, just set it and forget it. But make sure that you're building those good financial habits and those good financial disciplines, right? Because our emotions, oftentimes, it takes over. We're weird little creatures. I get it. We've all been there. We've all panic selled. Most of us. Some of us are smarter than others. But we've
Not
all.
me.
Nope, not me. I've done it. Yep. And now the stock's so much higher. But that's why we make smarter financial decisions, right? That's why we said, take a deep breath, learn from your mistakes. If you can learn from your mistakes and not make them again, man, that is an insane superpower. But I give it back to you,
and that's why
Chris.
it's so good to be able to take our time to make these decisions when we're emotionally sober, so that when we are emotionally hot or cold, we're okay. And again, it comes from learning. It comes from messing up and realizing that it was the wrong thing. So let's talk about the second stage of our wealth building journey, and that's the wealth preservation stage. This often happens when you're approaching financial independence or retirement, depending on the way that you decide that you want to run your portfolio for financial independence. During this time, what typically you see people doing is they gradually shift towards lower risk / income producing assets. Things like that would be bonds, dividend paying stocks, or alternative investments. Just so you're aware, bonds are just debt securities issued by the government or by corporations that provide a fixed interest payment. Something that I learned from Ray Dalio is that anyone's debt is somebody else's asset. So in order for you to have an asset like a bond, that means that somebody else has to have a debt against it. So you think of it that way. In order for me to produce, to have a good retirement, I need to go ahead and extract from somebody else. My asset becomes their debt. And that's the way that the entire system works the whole way through.
Could you say that quote one more time from Ray Dalio?
Yes, someone else, your debt is someone else's asset, and your asset is someone else's debt.
Wow. That's insane. I hope that kind of hit you guys as hard as it hit me. Like my eyes rolled back. I think I started levitating. That's insane. It's so wild. I love that quote. That's a powerful one. Keep dropping gems, Chris. We're all here for it.
I'll do my best. And the goal of the wealth preservation stage is to reduce our volatility so we can still generate returns while keeping up with inflation and not lose our minds. Because in this time of retirement, in the time of financial independence, when we're not producing more income, the hardest part isn't that the investments go up and down, because they went up and down even in the early stage. The hardest part is now you have to deal with your mindset and not seeing a steady paycheck come in every 2 weeks. That's the hardest part of it, is being okay with it. And just realizing that there are things you can control and things you can't control. Being able to set it and forget it is the hardest thing by far. Before we move on to segment 3, Dominic, you have anything to say?
No, I'm right there for all of it. I agree with all of it. I'm excited to keep going.
Cool. So segment 3, common sense investment strategies. Here at the Fi Guys, we love index funds because they, number one, track the market, like the S&P 500, the Dow Jones, or the NASDAQ. Number 2, they have extremely low fees, some as low as 0.01%. Number 3, they offer a broad diversification with little to minimal effort. And number 4, finally, they're tax efficient, which when they're held within their retirement accounts. So some popular indexes are the S&P 500, which to our viewers are 500-ish of the largest US companies. And what we use the S&P 500 for is a benchmark of how the US economy is doing. The next biggest index will be the Dow Jones Industrial Average. This one is the 30 largest established US companies that we have today. And the third one would be the NASDAQ Composite. The NASDAQ is heavily tech and growth company centric. So here at the Fi Guys, what we typically use is the S&P 500 as our general benchmark. When we're trying to say, hey, the stock market has returned on average 10%, we're talking about the S&P 500. But you can see that the S&P 500, the Dow Jones, the NASDAQ, on average have returned about the same. And how can that be when 500 companies return 300 versus 30 companies versus just a few in the NASDAQ? It's because the S&P 500 is also market cap weighted, meaning that the larger companies, the ones that make up majority of the NASDAQ or the Dow Jones, also make up a majority of the S&P 500. So again, we can use all of these almost synonymously. So when someone says, oh, I'm bigger into the S&P 500 than the Dow Jones, so I'm better than you, or I'm better than the NASDAQ than this, though I'm better than you. Again, in the long term, when you throw them in the washer, they all come out to about the same. So here's a pro tip. You should commit to the strategy and stay invested through the ups and downs, through what your uncle says, through what your best friend says, through what that guy at the bar said that he bought yesterday. Because the best thing you can do is set it and get the hell out of the way.
Couldn't agree more. I couldn't agree more. And if someone's, giving you crap for investing, in the market, come on now. What are we doing here? Probably don't need those guys.
I think
in your
you'd be
life.
surprised, Dominic, as someone who works in finance, like how common it is for people
Really?
to just to shit on other people for doing things. I would say the right way, in quotes, the right way.
Yeah.
For doing things in the best way that we know to work. How many people will say that's the dumbest strategy? And I think you have to look at that person's incentives. What are they trying to do typically?
Mhm.
Either they're trying to get you to buy whatever it is they're selling, or they want more people along to go with them so they don't have to feel so alone. Because at the end of the day, that's all it is that people are afraid to go into the wilderness alone. So if I bring more people along, at least I'm not alone. If we all fail, at least we all fail together than just me failing by myself.
Honestly, that's a really solid take. And it's kind of crazy to think that even people in finance, get really nitpicky about, oh, no, that's not the best fund. I got the best fund. This isn't the right stock. I got the right stock. And it's so interesting. I guess that's now that, it's one of those things, right? I hope you guys are listening to the podcast, right? Because over the years, it's changed how I think. And what you were just saying there reminded me of the book that we talk about a lot, the Miyamoto Musashi's The Five Rings. And, I'm seeing the way broadly right now. Like, there's always that guy in every job, whether you're selling paint, whether you're choosing stocks, whether you're making sandwiches. Like, oh, no, this isn't the right way. That's not the right way. And that other one, that's terrible. That's terrible stuff. Terrible. This way is the right way. And I'm starting to see a pattern. It's like the same person and the same people exist in every field. And it's kind of interesting. It's like, oh, that's just like a common cog in the matrix, man. I see it. I'm aware of it now. Now I can block that guy away because it's never good advice, right, Chris? It's usually never good advice.
Yeah, I don't like the words never and always, but it's True. Usually it's most often not good advice.
That's a good point. That's a good point.
Let's move on to segment 4, ETFs versus mutual funds. And where do indexes fit into this whole thing? Because we just talked about indexes a second ago. So mutual funds and ETFs are both baskets of investments you can buy in one shot. And an index fund are simply a type of either that tracks a specific market index like the S&P 500 or doesn't. So let's talk about some key differences between our ETFs and our mutual funds. Number one, when it comes to trading, ETFs trades like stocks, meaning you can buy and sell throughout the market day. Mutual funds price only once a day at market close, so you can only buy or sell at the beginning or at the end of the day. Minimum investments. ETFs usually have 0 minimums, so you can buy as little as 1 share, or you can even buy fractional shares with some brokerage accounts, meaning you can get started for as little as 50 cents. While some mutual funds often have pretty high, and by pretty high, those are in quotes, minimum fees, somewhere ranging from $500 to $300 or even $3,000. I've seen some as high as 10 grand. I've seen some as high as 100 grand. It really depends on where you're looking for. And then number 3 is our tax efficiency. ETFs generally are more tax efficient due to the in-kind nature of creating and redeeming processes of their shares, which can reduce your capital gains distribution. Mutual funds, on the other hand, are also pretty tax efficient, but they're more likely to distribute tax gains to you, the individual, when a large number of investors buy or sell. Because with a mutual fund, they have to go out into the market. They have to sell or buy stock when more people funnel into those mutual funds. And that's the reason that you'll see mutual funds, they kind of ebb and flow on how well they're doing. Because when they do really, really well, a lot of people move into them. And then they kind of go back down to average, if not below average. Where the ones that are doing pretty poorly, they start to do well because everyone gets out of them. And now they can actually run their strategy the way they're supposed to. Which makes it difficult because you're not going to be the person to know when's the right time to buy and sell, because there's that old adage, oh, it's really easy, just buy low and sell high. And that sounds really, really well and good when you know what's going to happen in the future, but no one does. And that's why everyone does the opposite. It sounds easy to do, but why do so many investors do the opposite? So our take here at the Fi Guys is we prefer low-cost ETFs because they're more flexible, they're easier to buy with any brokerage account that you have, and they have minimal ongoing costs. But a good index mutual fund can also be an excellent set it and forget it strategy, especially if you're using it in a retirement account. A retirement account like a IRA, where you don't have to worry about the distributions. You don't have to worry about the tax incentives until way later on in the future. If you don't know what we're talking about, we're going to get to that later on in the Fi Crash course as to the different types of accounts. But that's the reason that we prefer ETFs over mutual funds. But again, Everyone's strategy is different, and it all depends on what you're willing to trade off with in order to have your best strategy, because there are no solutions, there are only trade-offs.
I think that's what I love most about what you do, Chris, is you don't sit here on the highest of horses and say, mutual funds suck. Terrible. You're an idiot if you invest in them. Why would you? ETFs all the way, bro. No. You present both options fairly. You let them know what you do and what works for you in your specific situation, but also give the opportunity for mutual funds to kind of have their day, right? And I love that. I think that's a really fair and honest take. And I wish more people online were like that. Not just plant their flag in the sand and be like, I'm gonna die on this hill. ETFs till the day I die. It's like, oh, okay, weird hill to die on, but you do you. But I love that. I love that we can present both sides, because ETFs might be good for one person, or mutual funds might be good for one person, and it might not be good for someone else, right?
Yeah. And here's the big thing. It comes down again to what's the incentive of the person.
Yeah.
Because everyone who is, or most people that are saying like, oh, I only do ETFs, I only do mutual funds, they're trying to sell a course. They're trying to sell you on something. Again, the FI Crash course is free. You're listening to it for free. Like, we're not trying to get you to do other things here. We're people that love finance, that has changed our lives, and we want to present to as many people to help them get out of this hamster wheel of life that they're trying to get out of, to move on to bigger and better things. And that's the really nice way of looking at it, is that just because I prefer ETFs to mutual funds, they both exist because they both freaking work. And just because my way works for me and your way works for you, it doesn't mean that we're both wrong. They're just different, and that's okay. I think it takes somebody, or I think it's when you meet somebody who freaks out because you see the world differently than them, it's not that you're wrong. It's that they're so worried that they're wrong that they have to attack you for that. And in that case, who is the person who has the problem? It's the one who's doing the attacking who has the problem. It's not the one who is self-assured in himself to be able to present both arguments, and you say, oh, I'm actually going to go the opposite way of you. And you go, okay, that's cool. There's a scene in The Matrix, one of my favorite scenes. There's actually a lot of scenes in The Matrix, one of my favorite scenes. But I think it's in the third one, which wasn't the best movie. But Morpheus is arguing with one of the captains, and he's talking about his beliefs. And the captain goes, what if I don't believe in what you believe in? And then Morpheus says, my beliefs don't require you to believe. And I think that is one of the coolest mic drop moments in a movie, like ever, is that my beliefs, the way that I choose to live my life and what I choose to do with my money, it doesn't matter what you do, because this is what I'm going to do, and I know that it's going to work for me, or I believe that it's going to work for me. And if it doesn't, I can change it. Dominic, I know that you're just as much of a nerd about The Matrix as I am.
Such a nerd. So. I'm such a nerd about it. I'm as giddy as can be over here. Such a great movie. And it's crazy to me that there's people out in the world that have never seen The Matrix. Insane movie. And the more you think about it, the more your brain kind of hurts. Don't watch the fourth one. Don't waste your time. That's so actual so shit. It's a pure money. It doesn't even make any sense. It's a money grab. It's not even a good money grab. It's not even a good money grab.
I watched it 3 times because I thought the first 2 times that I must have missed something to make it make sense.
It still sucked.
It didn't. It still sucked all 3 times.
Yep.
But I think The Matrix is a perfect encapsulation, as perfect as you can get to like the actual way things work. Not that I'm saying that we live in a simulation, but like that we all live within the constructs of our own mind is the perfect analogy. So I'd like to move on to segment 5 of the Fi Guys to get back, or segment 5 of this one to get back off of The Matrix, but please watch The Matrix. Segment 5 is, do I really need a financial advisor? Do you, the listener, really need a financial advisor? And I think this is really important to bring up because too many people will say, yes, you need a financial advisor. You can't be financially successful unless you have somebody in your corner. To which we at the Fi Guys say, that's not really true. If you're willing to learn, if you're willing to try, if you're willing to fail, if you're willing to try to make it every day, or to learn our simple steps and just set it and forget it, you can be successful. And if you choose to have somebody else to help you along the way, that's okay too. Let's just make sure that you choose someone who has your best interest at heart. because this is the crazy statistic. About 90% of the financial service industry works on a broker-dealer basis. What that means is that 80 to 90% of people who are financial advisors, in quotes, do not have to put your best interest first. And that is a crazy statement to make. To say that only 10 to 12% of financial advisors are legally required to put your best interest first. If I go to the doctor's office, I never have to ask, hey, are you going to put my best interest first, or are you going to put the hospital before me? In truth, they're probably going to put the hospital before you, but that's just the system that we live in. And that's the system that we live in finance too. So broker-dealers are paid commission for selling investment products. Those broker-dealers typically work off of suitability standards. Suitability means, yeah, it's suitable. It'll fit. Like that suit, it fits. It's kind of big, but it fits. Or it's kind of small, but it fits. Versus other advisors. There are fee-only advisors. That's what I work in. Fee-only are paid, or I'm sorry, not fee-only, but fee-only are paid off of percentage of assets. So based off how well you're doing, that's how well they do. They're not getting paid commission. So they have something called a fiduciary standard, a prudent man standard. Would a prudent man make that action in the best decision of somebody else? And the final one is an hourly consultant. That's actually what I do. And that means that I'm paid per session or per review, paid a flat fee up front. Therefore, you know where the incentives are going. There are no other things to sell off in the background. It's a fiduciary standard because that's already been met. You paid me, now I give my best advice. So if you're going to find a financial advisor, there are some really important questions you need to ask. The first question needs to be, are you a fiduciary? And you need to hear that person out to say yes or no. Ideally, it's just a flat yes. But here's the second question. And it's sad that we have to ask this question. But are you a fiduciary in all parts of your business? Because finance being so complex means that people could be duly registered. Meaning that in some regards of their business, some regards of being a financial advisor, a financial consultant, a whatever you want to call yourself, I have to act in fiduciary standards. But in other aspects, I can work on suitability. I can work as a broker dealer and make commission. So you need to be able to ask that question. Are you in all parts of your business? For some people, the peace of mind and behavioral coaching of an advisor provides, or that can provide, far outweighs the fees that you're going to pay them. But remember that beating the market consistently is extremely rare. So if you're meeting an advisor who's saying that I guarantee that I can beat the market, I guarantee you should run away, because that's not something that people can just promise.
Remember, even the Oracle was wrong in the Matrix. So
there we go.
And I promise you, you don't have an Oracle as your financial advisor. Because if you did, they're not going to be a financial advisor. They're going to take their money and they're going to live it up large, Thailand or something. Do we have any action steps for this week's, Chris?
We do. So I want you to remember that long-term investing works. And it only works if you stick with it. If you're a long-term investor, quote unquote, who jumps in and out of the market, that's not a long-term investor. Too many people who I've met who say like, oh yeah, I just quit smoking. I quit like 5 minutes ago. I'm probably going to relapse in like another 5 minutes. That's the way I think about when I talk to investors who say like, oh, I'm a long-term investor. I just kind of get in and out all the time. It depends. That's the exact same thing with that person who says like, yeah, I'm really big into health. I went to the gym like 6 years ago, but I'm still in really good health.
Tony Robbins has this funny thing that I always thought was so interesting. You know, he's like, when you ask a smoker who's trying to quit, you know, it's like you ask how many days, you know, when was the last time you had a cigarette? He's like, oh man, I'm doing great. You know, I haven't smoked in 3 weeks. He's like, why are you counting? Why are you counting? Why don't you just say that I'm not a smoker? He doesn't identify. Like if I gave you a cigarette, Chris, you're not going to smoke. You're not going to smoke it. You're not a smoker.
No.
It's not part of who you are, right? So, and I hate to say this, you know where I'm going, but most of life's problems can be solved by knowing yourself and just understanding what goals align with the life that you want to live. So, like we talk about on every podcast, right? Make sure to live an intentional life. And all of what we're talking about here is amazing, right? It's great education, but education without action is just entertainment. And like Morpheus said, there's a difference between knowing the path and walking the path. If you're not walking the path, well, you're not going anywhere. You're just staying the same. Any final thoughts?
Damn.
Right?
Yeah,
That's
we
not
got to get
bad.
to the action step. That was good. That was good. I felt like that almost felt like it was scripted. All right. So our assignment for this week is last week's our assignment was to go ahead and open up an account, open the brokerage account, open the IRA if you already had the brokerage account. This week, I want you to invest any amount into that investment account. That could be as low as $5, $1, $10. Invest it into something that you believe in. That could be an ETF. That could be a mutual fund. That could be even an individual stock if that's what you want to do. That's not what I'm going to recommend you do, but invest it somewhere. We gain absolutely nothing from you doing this, but you gain everything by getting started, by being the kind of person that invests, by being the kind of person that looks out for their financial future. So I want to thank our audience members for tuning in to episode 8 of the FI Crash Course. Next up, we're going to be talking about tax optimization strategies, because keeping more of your money is just as important as growing it. Dominic, could you close us out, please?
Absolutely, guys. If you have a friend or family member you would like to join with you on this adventure, now would be the time to share this podcast with a friend. You never want to get to the end of the road. You get to the beach, you look around, and you're the only one sitting there. It's so much more enjoyable to bring your friends along, bring your family along. Hell, bring your enemies along. I don't care. Bring them all along, right? Everybody deserves financial independence. Everybody deserves to have freedom of choice, whether you believe choice is real or not. We're on a bit of a matrix kick today. But everybody deserves the idea of financial freedom and the execution of financial freedom and the results of financial freedom. So make sure to share the podcast with a friend, an enemy. Share it any way you can, because we don't really get too much out of this podcast, but we do love to teach. We do love to learn more about finance. And we're just going to continue going down this financial independence rabbit hole with a dash of movie references and corny lines. But with that being said, guys, make sure to like us, make sure to follow, make sure to share, all that fun stuff. But most importantly, make sure to make good financial decisions. And we're the FI Guys, and we'll see you guys back here on Friday. I'm Dom. He's Chris. I'll see you guys later. Peace.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.